Good evening. This is Ken Long from Tortoise Capital Management with a review of the daily trading plan for January 22nd, 2011. We'll start off with a look at the market in bullish normal conditions. This is after a 6-week excursion into bull quiet, which is the most favorable market of all for the large caps and for ETFs. And we've just entered back into the low range of normal. It's still favorable, but the increased volatility of January, now that perhaps traders are coming back and New Year money is starting to cycle into different sectors, we're starting to see a return to volatility. On an annual basis, SPY is at the high end of neutral at 70 on the weekly RSI, and at the middle range of normal on a 10-day index basis. The percent stretch above the 200-day moving average and the positive slope of the 50-day moving average are both very bullish, as indicated by the green highlights, still exceptionally strong. ADX at 33.5 is still strong, although it has pulled back in the last couple days after reaching a height of a little over 35. The ATR percentage at 0.88% is at the boundary of normal. The low-end boundary of normal, as you can see here on the volatility chart. And again, as volatility comes back into the market, it's harder to make easy money, and that's some of the sideways motion that we're seeing right now in the broad markets. On the gap stat, I want to highlight a continuing trend under the last 30 days, and that is 2/3 of the time, or 20 out of 30 days, the market has reversed from its opening. So it's either gapped down and then reversed to close higher, which it's done 8 times, or it's gapped up and then reversed to close lower than the opening 12 times. So that's 67%. 2 out of 3 times it's reversed that morning gap, and that's a significant tactical insight. The 10-day index, you can see, after being overbought for a long period of time, we've pulled back below, and now we're at the high end of normal. The standard deviation of the SPY gap is still at 0.75%. The average best intraday moves still is about 2.33% in SPY. The overreaction system has fired signals in U.S. small caps, Latin America, and emerging markets. Those were the 3 losingest sectors we saw from the ETF2 report. And then the channeling system fires long signals in the U.S. tech, U.S. small caps, again, Latin America, and emerging markets. The pivot point for SPY is at 28.59, with S3 being 127. In the Max Payne category, Merck, Bank of America, Verizon, Alcoa, and DuPont. In the ETFs, India, gold miners, South Africa, telecom, U.S. telecom, and Brazil. I like Brazil and Latin America because of the Max Payne conditions, and they're so volatile intraday. On the pattern trading, we've got a 5-day down signal in coal, 551 signal in Verizon and Japan, triple screen signals for Alcoa, Caterpillar, Microsoft, and Cliffs Natural Resources. The Elder Safe Zone from Friday showed weakening signal strength from Latin America, Asia less Japan, emerging markets, U.S. tech, oil, and steel, Cliffs, Natural Resources, and Caterpillar. The 30-60 stealth remain. Some of the defensive sectors like utilities and staples and real estate and China, and then large caps, Bank of America, that's Boeing, Kraft, Cisco, and Johnson & Johnson. So plenty of opportunities going into next week. In the daily tactical report, the percent losers, Microsoft, Alcoa, Bank of America. Alcoa and Bank of America are interesting because they are, again, 10-day max pain and 3-day max pain, and we're percent losers, so that's like a triple washout in my opinion. Merck is of interest to us. It was max pain on 10-day. It's the only Dow component that was oversold on a 10-day index, but it was not a percent loser on Friday, so perhaps the healing has begun. General Electric was the clear winner On Friday, news of CEO Immelt joining the administration, essentially for all practical purposes, looking to make a lot of money in his partnership with the Obama administration and tying their success to that of the federal government. Not a bad strategy, but I mean, it doesn't get much more transparent than that, the potential for corporate oligarchy. So you might want to start calling them government electric. Inside technology, we're starting to see some pullbacks affecting the 10-day indexes. The percent winners, Europe, agriculture, mixed commodities, finance and industrials. The losers were U.S. tech, small caps, emerging markets, and coal. Coal has pulled back and may offer some opportunities. The energy sector is strong, but coal is a 10-day, 3-day, and a 1-day max pain. And silver is a 10-day and a 3-day max pain, but was not a percent loser. It was basically flat on Friday. So I'll be stalking them carefully. Silver at just under 27 with a recent swing high of 30 offers a 10% on the upside, and 20% if you're using AGR as the AGQ as the double indexed. In the Dow pattern trading, only two dojis, Procter & Gamble and AT&T, channeling signals Alcoa, Caterpillar, Coke, and Microsoft. Triple screens in the same three minus Coca-Cola. And 551 pattern in Verizon, which is also number 2 on the max pain range compression. That's a very favorable potential. I really like this look here in Merck. Number 1 on the max pain range compression has been horrible from the 5-day out to the 12-month time frame, but not so much 1-day and 3-day, and that may be potential of a bottom setting in. ETFs, only one doji in the financials, lots of channeling signals, technology, small caps, materials, emerging markets, Latin America, gold and silver, oil and coal, so the commodity sector is offering possibilities. Here's the 5-day down pattern in KOL, coal, triple screen in Japan, and silver, gold, and coal offering 1, 2, and 3 in the max pain range compression. From Friday's safe zone calculations, you can see everything in red that was measurably weaker in terms of signal strength. Emerging markets, Asia less Japan, Latin America, technology, the usual suspects. The 30-day regression line, the R-squared at 0.93, is still very consistent, although you can see it's starting to loosen up here a little bit as we saw a couple days of pullback from the swing high. The percent stretch hasn't quite gotten to 2 standard deviations above normal and has pulled back a little bit, although still very strong. The slope of the regression line has crossed over its 10-day moving average and is pulling back towards normal. And we can see a little bit of the sideways movement in the price chart here. So I see this as a very strong bull that is starting to show its age and it's weakening a little bit. A 5 to 8% pullback here is well within the range of normal noise. In the Dow quality reports, again, I sort this by 31 to 60 day, the 2-month quality. I'm looking for red than yellow, so I like Kraft and Johnson & Johnson as stealth quality candidates. And really anything in the 30 to 60 day divergence category is something where a bottom could potentially come in. You see, this is sort of a typical pattern here where things go in waves, that things that were horrible 2 months ago and are not as horrible, the price improvement in the last month is what turns them green, whereas things that were fantastic 2 months ago in the green here are now slowing down in this past month. It's hard to see components of the Dow sustain their outperformance for extended periods of time, and that 1 month's cycling seems to be an important time frame for looking at relative strength inside the Dow. Inside the ETF top 30. Looking for red than yellow, you don't really see any there. The closest thing we got is probably Europe, which is against all odds starting to look pretty good based on the performance of last week, just on a pure quality basis. Energy and mid caps up here. Green and white are holding their value pretty well. You can see how far the mighty have fallen here in silver, which was green 2 months ago and is red this month. I like it long term still. This looks to me like a 1 month pullback that's going to provide some more stalking and trading opportunities. New report that I've added to the daily slide deck, and these are simply an extension of the daily pivots now that includes all of the top indexes that we track for the world market model, plus 5 symbols that I like to track as favored trading targets. INP being India, Alcoa, Silver Wheaton, because that's essentially a double leveraged silver fund, and with additional volatility. Intel and Merck. Merck I like just because I'm stalking it as the anomaly in the Dow. Its pivot point at 34. And it closed at just 33.96 on Friday. So you can see it's got you can see the pivot analysis for those symbols as well. And that's everything I wanted to cover for the daily trading plan. We have a lot of patterns. We have, most importantly, these signals here in the overreaction and channeling are an indication that the market has definitely pulled back on a broad basis, and this would be a natural place for more money to come into the market to reinforce the buy on dips strategy. I'd be looking for technology and small caps, which have been the leading candidates. Small caps especially because they made a volatile move as well as a channeling move, and so I'm looking at TWM as the double short in case it starts to break down instead of resuming its upward move, or UWM if the small caps are starting to outperform SPY. So that's everything from the daily trading plan. This is Ken Long from Tortoise Capital. Good trading. Keep your powder dry.